Opendoor Technologies is trading live at $8.98, a staggering intraday explosion of over 53%. The volume is colossal, already cresting 430 million shares, as the stock carves out a new 52-week high. But while the ticker flashes a vibrant green that mesmerizes retail traders, the real story isn't this parabolic price surge. The truth is, this isn't a fundamental reevaluation of the business. It's a desperate, dramatic corporate shakeup igniting a massive short squeeze, turning this real estate technology firm into a battlefield for market forces far beyond its control. What we are witnessing is a classic case of expectation versus reality, where the expectation is that a new leadership team can instantly solve a deeply flawed business model, while the reality is that the brutal economics of iBuying in a volatile housing market remain unchanged. The news that former Shopify COO 𝐃𝐈𝐒𝐂𝐋 is taking the helm as CEO, coupled with the return of co-founders 𝐃𝐈𝐒𝐂𝐋 and Eric Wu to the board, has acted like gasoline on a fire. This, along with a new $40 million investment from Roubois's venture firm and Wu, was the catalyst. The market narrative you'll hear on social media and across various online investing forums is one of triumphant revival. The expectation is that founder DNA and an AI-native executive will magically restore profitability and revolutionize an industry. This has created a frenzy, with investors using platforms from Fidelity to the Robinhood app to pile into what they perceive as the next big comeback story, reminiscent of the meme stock craze that propelled other heavily shorted companies. However, the brutal reality hidden beneath this 53% surge is that Opendoor's core challenges are macroeconomic and systemic. The very business of iBuying, purchasing homes directly from sellers for cash, making light repairs and reselling them for a thin profit, is exquisitely sensitive to interest rate fluctuations and housing price instability. For months, the company has been navigating a treacherous environment where rising mortgage rates choked off buyer demand and forced them to sell inventory at losses. This leadership change, while optically powerful, does not alter the Federal Reserve's monetary policy or the affordability crisis gripping the American housing market. The surge is a reaction to a perceived change in strategy and a massive squeeze on the more than 25% of the public float that was held short, not a sudden improvement in the company's ability to generate sustainable cash flow. Sophisticated traders using platforms like Interactive Brokers understand this nuance. They see a volatile trading vehicle, not necessarily a sound long-term investment. This isn't a steady performer like Apple stock or a secular growth story like Nvidia stock. It is a high-risk gamble on a corporate turnaround facing immense external pressures. While the new leadership's focus on becoming an AI-first company sounds promising, the practical application of AI in predicting hyperlocal housing price movements with the accuracy needed to protect razor-thin margins is an unproven thesis, especially when market dynamics can shift on a single CPI report. Looking at the recent trading history, this explosion didn't come from nowhere. The stock has been on a tear for 3 months, rising an astonishing 874%. This wasn't built on earnings beats or fundamental strength. It was a slow-burn accumulation by retail investors and a growing unease among short sellers. The daily trading volumes have been escalating, creating a powder keg that the leadership news finally ignited. Today's move blew past every technical resistance level, gapping up at the open and never looking back. This is not orderly price discovery. It is chaos, driven by algorithmic trading, FOMO, and margin calls. Institutional investors who manage wealth through services like Fidelity Wealth Management or Schwab Intelligent Portfolios are likely viewing this volatility with extreme caution. While some may be participating in the short-term trade, many will be waiting for the dust to settle to see if this new management team can articulate a credible path to profitability that doesn't rely on a perfect housing market. The consensus analyst rating remains a hold, with price targets that are now laughably disconnected from the current trading price, highlighting how fundamentally divorced this stock's movement is from its underlying valuation metrics. To understand the core of the challenge, one must understand Opendoor's business. The company pioneered the instant buying or iBuying model. For a homeowner, the value proposition is compelling: certainty, speed, and the avoidance of showings, repairs, and lengthy negotiations. Opendoor makes a data-driven cash offer and, if accepted, can close the sale in a matter of days. It then takes on the risk of owning the home, performs necessary maintenance, and lists it on the open market, aiming to sell it for more than its all-in cost. The company's revenue comes from the service fee it charges the seller and the profit, if any, on the resale. When housing prices were steadily climbing and mortgage rates were at historic lows, this model worked. Appreciation acted as a safety net, covering operational inefficiencies and mispricing. But when the market turned in 2023 and 2024, that safety net vanished. Opendoor was left holding billions of dollars in housing inventory that was declining in value, leading to massive write-downs and staggering losses. Their past performance is a testament to this vulnerability, a stark reminder that they are, at their core, a leveraged player in the cyclical real estate market, not a pure-play technology company. Many investors looking for investment help through various online investing sites often overlook this cyclical risk, focusing only on the tech narrative. Looking forward, the future of Opendoor hinges on two critical variables: the successful execution of its new AI-first strategy and the trajectory of the U.S. housing market. The bull case is that Najadian, with his product and AI background from Shopify, can genuinely revolutionize Opendoor's pricing and risk management algorithms. If the company can use artificial intelligence to more accurately forecast home values, manage renovation costs, and optimize selling strategies, it could potentially achieve consistent profitability even in a flat or modestly appreciating market. A potential cut in the federal funds rate, which is anticipated later this month, could also provide a significant tailwind, making mortgages more affordable and stimulating transaction volume. This is the new expectation: a tech-powered, lean, and precise operation capitalizing on a stabilizing housing market. The leadership's ability to secure a $40 million investment signals a degree of confidence from those who know the company best, providing a crucial capital cushion. However, the reality presents a minefield of risks. The housing market remains fragile. While some regions are stable, others are still seeing price declines. Any unexpected negative economic data could push mortgage rates higher again, immediately pressuring Opendoor's model. Competition, though diminished after Zillow's exit, still exists from players like OfferPad and a growing number of traditional brokerages offering their own streamlined services. The greatest risk, however, is execution. A strategic pivot towards AI is complex and may not yield immediate results. The company is still burning cash, and its ability to achieve positive GAAP net income is far from certain. Investors using platforms like SoFi Invest or those managing their own individual brokerage accounts must weigh the allure of today's spectacular rally against the profound underlying business risks that have not disappeared overnight. Given the immense volatility and the starkly divergent potential outcomes, I want to know your take. Comment below with how many shares of Opendoor you currently hold, if any, and whether you believe this rally is sustainable. In conclusion, the explosive 53% surge in Opendoor stock is a textbook example of market narrative overwhelming fundamental reality. The expectation, fueled by a dramatic leadership overhaul and the promise of an AI-driven future, is that the company has been reborn. Investors are betting on the founder magic and a seasoned tech executive to steer the ship out of perilous waters. The reality, however, is that Opendoor remains shackled to the unforgiving economics of the iBuying model and the cyclical nature of the real estate market. Today's price action is a short squeeze of epic proportions, not a sober reflection of future cash flows. While the new management certainly brings a renewed sense of hope and strategic direction, they are inheriting a business model that has yet to prove its resilience across a full economic cycle. The ultimate success of Opendoor will not be determined by today's manic trading, but by its ability to navigate interest rate uncertainty and fundamentally re-engineer its margins before the market's enthusiasm inevitably wanes.